We started this report as we were preparing new financial instruments and ETFs and building new products and listening to what regulators were saying, and we wanted to take a data-driven approach to what was labeled broadly as market manipulation along the way. And we think that Bitcoin is a very unique asset in that regard, because of the ability to look at what's happening on chain, and because of amazing teams like CryptoQuant that are able to visualize that for everybody else.
What is the general message of the report?
And when we started working on this report early last year, the real purpose was exactly that. How can we combat that narrative of market manipulation in light of assisting research for the SEC, for regulators, and for the general public to approve a Bitcoin ETF. This was back in February of last year. So the entire report was really based on this premise that we wanted to push back and really examine the fundamentals by using the technicals to ensure that everyone understood this is different. 2021 and now 2022 is a different time period than 2017, then 2016, then 2000, all the way through. So from a on-chain analysis perspective, we can see, but also the historicity behind it of what was happening that did move the markets in these earlier time periods, whether it was Plus token, et cetera. So what I've found very interesting about this report is that ever since we started working on it, it's definitely held up. Whereas we're, finally publishing it now, March 16th, or I guess 17th for you guys, because it's in the morning now. But it's a origin story was exactly that, trying to push back against the narrative that the Bitcoin marketplace is just rampant with market manipulation. And it, therefore shouldn't have an ETF. So obviously we do believe that an ETF, we're very happy that it was approved last year. And we did want to push back against this narrative. But I will, I'll punt it to Sean just a little bit on this one. Sean, maybe could you speak a little bit to the breakdown of the piece? We have, as the beginning part, the on-chain transparency. It goes into Bitcoin in historical context, network adoption, et cetera. But, as you were starting to build out these themes, why did you think about it this way? Why did you want to lay it out this way?
As to the report, it takes a deep dive into Bitcoin and how it has matured over the years, as Leah was just saying. And it makes the case why it is ready to be an even bigger part of the global financial system, and why it's ready for even more mainstream financial instruments. There are basically two big sections to the report. The first gives historical context to Bitcoin by diving into the 2018-2019 bear market and walking through that period by breaking down the on-chain metrics involved that help to verify and almost every event that happened during that time, including events where a lot of people would just say, hey, that's market manipulation. But in fact, we can see what's happening on chain. The second part picks up on the heels of that bear market in 2019, because the infrastructural changes that were made in those years were a very important development to allow more parties to enter the market. In my view, this was kind of Bitcoin's moment, a bit like Clark Kent jumping into the phone booth and emerging as Superman, because in 2018, we had retail, and then all of a sudden in 2021, we've seen institutions and even nation-state involvement because of the developments in infrastructural progression that occurred in that time period.
Were there any significant indicators or metrics that kind of stuck out or that you used within the report for market analysis or for Bitcoin derivatives, things of that nature?
we dove really deep into the flow of Bitcoin around the chain. So KYC versus non-KYC, and what's happening as more and more, because there's more and more KYC exchanges in the US. So what happens? What the hypothesis is that some of it moves off, some of the Bitcoin will move offshore. Well, it also happened at the same time where CME futures came out, but not everybody can really access futures. And then we had the Bitcoin derivatives markets with the perpetual swap contracts that were kind of revolutionary just in how they're organized. And so we did see Bitcoin flowing from the US to offshore exchanges. It's a nice signal for US regulators where something like an ETF would really help to bring Bitcoin, onto shores and into regulated products. And that's really something that's one of the main takeaways of the report that we had.
What is your view on the crypto market and this idea of diminishing decentralization? Do you think that this is something that we're experiencing?
Yes, I mean, it depends on your viewpoint. If you're talking in regards to custody, I think custody solutions are exploding in a good way. I think more and more DeFi, everything is available, lending, borrowing. Those are going multi-chain, multi-protocol, multi-everything. So in my view, I don't think we're diminishing decentralization as far as that's concerned. We're certainly seeing maybe fewer centralized exchanges, and maybe we're seeing, merging and acquisitions, if you will, of just generalized exchange activity, I guess you could say. And it's sort of migrating to bigger and bigger players slowly. But I don't really think we're diminishing in decentralization in that regard.
What do you think has been maybe the largest macroeconomic shift that's been positive for the adoption of Bitcoin, and specifically, as we see it in the US?
Yeah, so I think we're seeing more and more people globally decide for themselves that you don't need Bitcoin until you need Bitcoin, and you don't need this decentralized money until you need this decentralized money. And when you do, you really notice it, and you really are impacted significantly by it. Something that immediately comes to mind is obviously Ukraine and everything that's going on there right now. But those people there are, it's life-saving right now for them. It's life-saving for people. Bitcoin's always there for you, whether or not you like it or need it or don't need it. It's there for you to use as a tool, right? And more people are seeing the need for it in their lives, certainly. Sean, how about you? Any additional factors there?
This along the same lines. I don't think anybody will argue that the macro picture has taken on extra levels of complexity in recent years. And it's funny. Josh and I were talking last week, and I asked him if he ever misses the days when the crypto industry didn't attract so much attention. But in many ways, we knew that these days were on the horizon, where we can actually see Bitcoin growing into an asset of crucial not only macroeconomic, but social and even cultural significance, based on its core values. And in a lot of ways, it's helping people, just like Josh was saying.
To add to that, actually, Keith, to bring you back on, if that's okay, just because you're able to represent the Asian climate and what you're seeing over there. What are your thoughts from what you're seeing and living of the most important macroeconomic developments that you think that we should be looking at?
What's going on in Asia, basically, I think in terms of regulation, a lot of Asian countries, they're pretty becoming more open to cryptocurrencies. For example, Mr. Yoon, he is going to be our president soon in South Korea, and he said, our country will allow to do ICO soon in South Korea. It has been banned for like years, but eventually he kind of accept the cryptocurrencies can't be banned in the future, and this allowing doing ICOs is kind of first step for launching ETFs, ETPs, and other cryptocurrency funds in Korea. So I think starting from South Korea, it's Japan will do as well, and other Southeast Asian countries will allow cryptocurrency in the near future. So it's about time. But I'm not sure China will do that. But Japan and South Korea has been pretty conservative, but nowadays their move will be more aggressive in terms of regulation, I think.
What do you think the implications of Joe Biden's executive order will be on the market?
I think overall, it could have been much worse, right? It could have been crypto's bad, crypto's banned, blah, blah, blah. The stuff that many of us maybe feared or have feared in the past. But it wasn't that. It was definitely a clear attempt to provide regulatory clarity in a time of need, in a time that many digital asset companies are seeking this regulatory clarity in all sorts of ways, custody, staking, taxes, which regulator is going to be knocking at somebody's door tomorrow, that sort of thing. Like we want to be involved with regulators. We want to talk with regulators. We want to be able to provide, sound information like this on-chain analytics stuff, volume information, anything that they need, because many of them are learning this stuff for the first time as well. So if you take it from that angle and say, these people these regulators may not know what's going on, right? So it's our job to help educate, and that's certainly what reports like this helps with in that regard.
What do you think are the main considerations of protecting the investor? Kind of following up on that, what are the regulators worried about, so to speak?
It's going to take regulators getting more comfortable with the broader ecosystem before they can approve a Bitcoin ETF. So I think it's going to take exchanges registering with the SEC and a couple of other key linchpins to get them more comfortable. So I think that there's still a lot of work to do and a lot of guidance to be had. Probably more regulations down the pike to get on other altcoins in order to get us and Washington to a more comfortable level to approve this spot Bitcoin ETF. But I think we have a little bit of a ways to go. And yeah, I guess just in sum that it really requires the oversight of the broader market, not just Bitcoin. So it's interesting trying to explain the nuances and differences between Bitcoin and other altcoins. And I think those are still the conversations that are being had right now. And at least, that's some of the conversations we're having.
But Sean, what do you see is, the future of Valkyrie's use of on-chain data? What are different things that, you'd like to see in the space?
I think that, for short-term investors, they look at, for short-term traders, they look more at like derivatives metrics and open interest and funding rates and stuff like that. But for a medium or long-term time horizon, the on-chain data really gives us an idea of what to expect in the coming months and years. And so as more regulated products emerge, I'm really interested to see what new metrics we're able to come up with and think of along the way. And I'm always going to ask this question of Guy anytime I see him. I'm going to say, where are we headed on chain? Because I think he has a lot of insight on this.
As you might know, this report is written for to persuade regulators. So we put a lot of insights about our regulatory issues. For example, exchanges who are doing KYC, the number of exchanges is KYC exchanges is increasing when you see on-chain data. So basically, KYC bitcoins is increasing as well. So it's really important to see how many bitcoins are KYC'd and how many bitcoins were non-KYC'd. And also, we put some insights about illicit transactions like plus token. A lot of regulators keep saying, hey, Bitcoin and other cryptocurrencies are used for money laundering, and there are tons of illicit transactions. But what we saw there was scam projects like plus token. They kind of succeeded in turning Bitcoin to fiat a while ago. And after those big scam projects, a lot of pretty good AML solutions like Chainalysis and Elliptic and others, those guys, on-chain providers like us as well, we our technology to track down those illicit transactions is has been evolving a lot. Along with those technological improvement, regulations will go forward.
How do you feel like the retail trading experience or appetite or even personality has maybe changed over the past however many years you want to add to whatever I'm about to ask?
The fact that Bitcoin and crypto in general, digital assets, has grown so rapidly, so quickly, has certainly been an invite for large institutional players, whether it be VC interest. Again, custody is massive with institutional anything. You have to have solid custody, and with crypto and digital assets, you got to figure out what that means to people, what custody means for certain institutions or certain legal entities. Volumes have changed, time of day, trading seasonality has changed a little bit. It's definitely, I want to say less reactive, but that's on some days that's certainly not the case. We still see this connectivity with legacy markets more recently than probably ever before with Bitcoin, and that certainly speaks to this connection with the people who are here now, which are institutional players and players who are trading other assets other than Bitcoin, but treating Bitcoin as something that's within their wheelhouse to do, which is why that correlation probably stands so high. But the retail people are certainly still here. We saw that with with Stonk Mania back in 2021. I don't think retail is necessarily going anywhere, but it's definitely important to understand that institutions can't just sort of jump in head first and hope for the best. They need regulatory framework. They need dot their I's, cross their T's sort of situation before they get involved. But we're slowly seeing that. It seems like every day you see these headlines for custody this, custody that, or some local bank, right, just out of the blue deciding we're going to start doing custody for customers. And any one headline like that maybe isn't that big of a deal, but collectively, that's a massive win for crypto for sure.
How have you seen the evolution of on-chain data, kind of starting with CryptoQuant's client base really being majority, an overwhelming majority of retail clients and customers, to now seeing more, whether it's hedge funds or traditional funds and banks coming into the space? What would you say the biggest differences are between those two client bases when we're considering on-chain data?
In most cases, retail traders are more short-term focused, and institutional investors are more long-term. They have more long-term view. Things like on-chain indicators like MVRV and some of the indicators to see cyclic bullish top or bottom. Those indicators are pretty popular among institutional investors because they buy and sell Bitcoin just a monthly basis, not daily basis. Retail investors, they are focused on market data mostly, not on-chain data, because for most cases, retail traders, those who actively look at data, most of those retail traders are derivative traders. They do futures, so they look at funding rate and open interest and others. When retail traders are active in exchanges, we can see that through on-chain data. For example, derivative inflows from other exchanges, the average amount of derivative inflows from other exchanges. When this the average amount of Bitcoin deposit is increasing, we can say, okay, whales are sending Bitcoins from other exchanges to derivative exchanges to open some long positions. And when this value is decreasing, that means retail investors are more active in derivative exchanges. And when you see this data, when retail traders are active in derivative exchanges, the market is likely to be at top. And when whales are active in derivative exchanges, the market is likely to be on local bottom. I want to say, okay, retail traders, you have to focus on on-chain data and you have to trade your asset more long